Welcome to today's Fireside Chat. Firstly, welcome, Simon.
Hey, Brendan. Hello, everybody.
And welcome all. Thank you for joining us. We have had an interest rate rise. We have had in the last week 0.25 added to the interest that banks can charge us and that we need to pay. And there's a consequence of that in cash flow. What we want to do today is go through why they did that and share with you our thoughts.
Let's go through a bit of a debrief on what the Reserve Bank actually said in its statement that accompanied the 0.25% rate rise that we've had this week, and look at some of the things that really stood out in that statement, because there's some different stuff in there this month to some of the previous months, and try and look at the big question, like for those who've got children and been on road trips, the whole "are we there yet? Are we there yet?" kind of call out from the back seat. We're all kind of feeling that. Is this it? Is this the last rate rise, at least for a while? Or are there more to come? Are we going to see another one in June? So we'll talk a little bit about that today as well. Let's start with what the Reserve Bank actually said. All right, there were a number of things that I've highlighted here that the Reserve Bank said this month that I think are worth paying attention to. So obviously the overall decision was to put up rates by 0.25 percentage point, which is taking the cash rate that the Reserve Bank uses to influence the interest rates that we actually pay. It's taken that cash rate from 4.1%, where it was after the last increase in March, to now 4.35%. So why did they do it? Well, there's a couple of things. One is, whilst we are all very aware of the Middle East conflict and what that's doing to things like petrol prices and the risk that's flowing through into the broader economy, that's not the primary trigger here necessarily. The Reserve Bank remains concerned that inflation, underlying inflation in particular, when you strip out the volatile stuff, that underlying inflation has been higher than it would like it to be for some months now, and really coming off the back of last year. And
sorry, interjecting. So are you suggesting, Simon, that we were already going to be facing this 0.25 in irrespective of the war?
Yeah, that's an interesting question, because I think there's a big question around timing around that, and whether the Reserve Bank might have been quite as trigger happy as it has been in the absence of that. And I want to come back to that a little bit later, because I think there are some statements in here which kind of go to the heart of that or answer that question. But in terms of the explanation that we were all given, they did call out the pressures that were already there in underlying inflation, which they talk about being related to capacity issues. In other words, too much underlying demand in the economy for the economy's ability to supply to that demand, irrespective of what's going on with petrol prices. So how do you try to cure that? Well, you try to rein in demand to get demand back in line with what the economy can actually supply. That's the theory, at least. But they do obviously acknowledge the higher fuel prices, higher commodity prices, things like gas and so on, which are already adding to inflation. So they do note that that is already starting to show up in the inflation figures that came out. And they recognize right up front that a lot of firms are feeling those cost pressures and are already looking to increase prices. And so we're going to be seeing that at the supermarket. We're already seeing that at the Bowser and so on. The other thing that they note, and this is something that is an interesting comment, that inflation expectations have also risen. Now, there's an element in my mind of, well, duh. Of course they have. Everyone can see what's happening with fuel prices, and we're constantly being told by the media that prices will rise. So, of course, inflation expectations have risen. But it's kind of like, well, there's a difference between expectation and reality. It's simply a reality. It's baked in now. And I think there's some acknowledgement from the Reserve Bank around that, but I probably want to come back to this inflation expectations question in a minute as well. Let's look at what else they said before we do that. Baseline forecast has been updated, now sees inflation peaking higher than they were previously expecting before the Middle East conflict. So that's changed the forecasts. But they do say that once it has peaked, it declines as demand growth slows and capacity pressures ease in response to higher interest rates. The fact that we've had these interest rate increases is now being built into the forecasts, and they're seeing that as, or at least they're trying to communicate, again, managing inflation expectations, that should pull down inflation in future, that increase.
So you're suggesting that they're suggesting that this is a temporary spike.
I think they're quite
They're
explicit.
seeing it as a temporary spike, not as an inbuilt systemic thing that we need to sustain and drive down over time, which is what the 2022 claims were. This is a spike in price and should come back quickly-ish.
Yeah, I think that's right, Brendan. I think more than that, they're also trying to make people believe that, which comes back to this inflation expectations questions. One of the
So
things that
there's
came
some
out,
marketing involved. I didn't know she
very,
was in
very much
sales.
manipulation even. So if you look at what Michelle Bullock, the Reserve Bank governor, said in the press conference after the RBA rates decision was released, she said a couple of things that I think are quite telling here. One is that they weren't expecting this rate hike in itself to actually impact inflation over the next 6 months. That those price rises are baked in. So again, there's a difference between reality and expectation, right? Reality is that the price rises are going to happen. But she did say, on top of saying that because of that, it's reasonable for businesses to pass on those costs to consumers. So not that businesses need the RBA's permission to do that, but kind of it feels almost like giving that permission.
So hang on. There's a couple of things out of that. One is an acknowledgement that there's at least a 6-month lag time from the time an interest rate rise is declared to the visibility or the impact of it being felt and seen. In statistics, the data takes a long time to come through and to show evidence of existence. So while the feel is immediate, as soon as the banks raise their rates and everybody with a mortgage goes, ow, the feel is immediate, but the data lag time on that is a 6-month thing. And based on her data or the acknowledgement of I can only see what's going on through data, 6 months is really much, we are facing some pain for 6 months. This is going to add to that, suck it up, but you should be okay. It might be coming down later.
Something
Expect
like that,
the businesses to pass those costs on.
Exactly. So that permission again. There's a couple of interesting things in there, though, aren't there? In acknowledging that, hey, this isn't going to impact inflation for 6 months. We just had 2 rate rises successively before this. So this is the 3rd one in a row in almost as many months. So if it's not going to impact things for 6 months, you haven't had time to see what those first 2 rate rises this year before this
There's
one
no contradiction.
have actually done.
There's no contradiction in that, Simon.
I kind of feel a little bit of internal conflict around that. So on the one hand, you're saying, well, yeah, we don't expect this to have any impact over 6 months, but we just also did a couple of things that won't also have had an impact yet, but we're adding another one on top of that. Are you adding more risk to the economy, maybe risking going too far? And that is a question that's being asked. And I think it's a fair question. And the Reserve Bank's response to that is, yeah, there's a risk. We don't think that we're at that point yet. But I don't know how reassuring people actually find that. It's kind of yeah, we hope we haven't gone too far kind of a statement.
I think that goes back to one of your original things and the question we spoke about earlier, which was, you declared or suggested that given the circumstances that we're facing based on costs going up because of fuel, there is a certain liberal perspective taken by them to ramp it up anyway, because it's going to go up anyway. Let's see what we can do to create that buffer that she's declared is something that will allow us to then bring it down and be okay.
Yeah, and I want to come back to that because there's some statements in the Reserve Bank's commentary that kind of lean into that. But before we do, I want to just address this inflation expectation issue. Okay, so we've said it's not so much about expectations; it's a reality that prices will go up over the next 6 months. We've said that what they've just done in increasing interest rates isn't going to change that. And then what she follows up with in the press conference is a statement that what she doesn't want to see is that once that peak is passed, once that oil shock impact has passed, that consumers, the Australian public, continue to expect sort of 4 or 5% price increases as like the normal course of things. And, part of doing this, I think, is showing, hey, we're determined to bring inflation down. And so you shouldn't expect that. And that's part of the reason why we're putting rates up, is to manage those expectations. Now, is she treating Australian consumers like idiots, Brendan?
I'm not so sure she is. She's old. Yeah, with respect, she's old. But
You can
then,
say you're allowed to say that.
Oh, more so as I age, yes. But no, that's not my point. She's old insofar as she's experienced the years when internalized expectations about life at higher interest rates existed. And it was a really, really tough battle back in the 80s to get interest rates back down from the 18% inflation, from the 10% into the lower sixes and sevens. It was a really tough gig. And it was the recession we had to have, period, because there was an inbuilt expectation. She's attempting to preempt that, I say, or reflect on that. She doesn't want that. Now, my read is that if people are expecting inflation now, I mean, people's memories are short, populations' memories are short. Just talk to any politician. You can justify anything for a week, and then everyone's forgotten it, and then make some declaration about how bad and wrong they were then, even though
you're
a
saying
week
people
before
are
they said it.
idiots. So you're saying people are idiots, and we do need to manage that.
No, I don't think they're saying that people are stupid, but I think there's a recognition of short memories. So I don't see it as being patronizing, but I do see it as a we don't want to get their statement, probably more off the cuff than managed.
Yeah, and I think I do credit people with enough understanding that they don't think that 5% price increases per annum is the normal, would be the norm after this. I think a lot of people do recognize that we have this conflict, and that's a big issue, at least for the near term, but that it's not a forever issue. And I would hope that the Reserve Bank gives people enough credit to recognize that as well. Coming back to the statement then, a couple of other things I just wanted to highlight. One was we're not in a GFC kind of a statement. Credit is readily available to both households and businesses. So the lending isn't clamping down. Yeah, obviously raising interest rates means people can borrow less at the same servicing. But it's not like there's a lockdown on credit or anything like that. And then they recognize there's a whole lot of uncertainty. So there's almost a recognition of we can't really put hand on heart and say we know exactly what we're doing here because of all the uncertainty that's going on. So we're kind of muddling through as best we can, kind of a statement. Outside of the uncertainty, we've got higher prices and fuel prices are adding to inflation. There are indications it's likely to have second round effects on prices of goods and services, so that flow through. So we're still going to see more price pressure. And that's in addition to the higher underlying inflation that we already had at the beginning of the year due to these so-called capacity
spike peak.
Right? This last statement here, inflation is likely to remain above target for some time, and the risks remain tilted to the upside, including to inflation expectations, and therefore we judge it appropriate to increase the cash rate target. So again, we're trying to make people understand that this won't be a forever thing. Inflation will come down. Don't start to expect that you're going to need to ask for big wage increases and so on.
Correct.
And
that's their anxiety.
Spiral.
Yeah, right? That's their anxiety. Union action. I can't afford it. Pay me more. Large government institutions being asked to pay more for wages. Basically, this is a short term, suck it up, tighten the belt. Know you're in pain already. It's only a little bit longer. We'll bring it all back down. But if you choose to go after the money, then you're making it last longer.
Yep. But I think, like, all that aside, when you look at the last couple of statements, comments in the Reserve Bank statement, these are particularly telling. One is, and you mentioned this before, Brendan, this statement, having raised the cash rate 3 times now, monetary policy is well placed to respond to developments. So if we jack up rates now, it puts us in a position where we can more easily bring rates down, perhaps faster later, if we see things like runaway unemployment. It's almost like we've got all this uncertainty. We're just going to jack rates up now because that'll just give us the bigger buffer that you mentioned, Brendan, to be able to make changes later if we needed to. That, I think, is a key part of this. And that also came out in the press conference with Michelle Bullitt talking about the idea that one reason for, and this is a direct quote, she said, one reason for deciding to increase interest rates was to give ourselves space now to sit and see what happens. And they say one reason. I think that appears to be, in my mind, the key reason. We just want to build up a buffer and then we can sit back. Now, it was a split decision still. At least one member voted to leave the rate unchanged. So there are arguments both sides here. But at the end, the majority ruled and they put up rates. And it feels like they did it to create that buffer.
My mind now goes to politics. I can imagine that if the spike goes up and then comes back while Labor's in power, they can say, look what we did to make interest rates come down. If they lose, and you'll get Liberal going, look at the inflation impact that's caused by the Labor government and their spend. They've contributed to the inflation going up. So both sides might be able to. If we have an election before it comes back, Liberal will be able to say when it does come down, look what we did, we're good, aren't we? So great. And look at how Labor screwed us in the first place. You know, and you talk about Michelle Bullock calling people dumb or patronising people. What do you think Liberal and Labor do all the time? They hope and pray memories are short.
You just raised an interesting point there, though. There was no mention of the budget in the statement, right, at all. And obviously we've got the federal budget next week.
And there was.
And one of the arguments that you could have made against raising rates right now would be to wait and see what's actually in the budget. Because you're not fully informed at this stage in terms of where the government might spend or not spend money. Is it going to inject money or not? There was a comment in the press conference that you could read as a swipe or a warning, potentially, that Michelle Bullock did say, I'm going to quote from her again here, all I'm saying is that the extent to which government make up the shortfalls for households by giving more, it makes it harder to dampen demand. So it's basically saying, hey, don't just give people handouts in the budget because that's just going to make our job harder. And guess what? We might have to put up interest rates again if you do that.
There was additional commentary from others around the space going, and it looks like the government's not going to listen.
And but that's a problem, right? If that turns out to be the case, if you've actually got the government's own spending policies working against the desire to rein in demand and do whatever they can to control inflation, whether or not you agree that interest rates are the right tool to do that, it creates an ongoing tension. So I don't know for sure that that's there, but it was just interesting to see that comment thrown out in the press conference.
If you look at the underlying reasons, I think that the government's looking to be re-employed, whereas Michelle Bullock's employment is certain. So you've got a scenario where the government's gone, going to splash the cash, so I get back in. At least I get to put food on my table for longer.
And the irony is that any attempt to create cost of living relief by putting money back into people's hands just can be undone by adding to the inflationary.
Yep. There's no self-serving purposes in that at all.
All right, so let's switch
Simon,
gears.
Final comments.
Yeah, let's switch gears quickly. In terms of expectations moving forwards, what was interesting, especially with that give ourselves space to sit and wait and see what happens kind of commentary that's in the statement and that came out in the press conference, the money markets immediately revised down their expectations with respect to future interest rate increases. So they had been pricing in even up to a couple of additional rate rises happening later this year. They've pushed that out. They now see only about a 17% chance of an increase in June, and the possibility of one further increase maybe somewhere between September and February, but not a certainty. The money markets have certainly pared back their expectations. So could this be the last rate rise? It could be on the balance of probabilities. Can we say that with certainty? Of course not, but it is interesting to see the money market reaction to these comments as well. A couple of things to watch. I'd be watching the unemployment rate. I think that's key. If that starts to spike up, because the Reserve Bank's revised forecasts are based on the idea pretty much that unemployment doesn't really increase much from where it is now for the rest of the year. If that proves not to be the case over the next couple of months, then you could see some softening of the RBA's stance.
I'd also say watch the retail sales. It's a leading indicator to sentiment. Retail sales themselves, if they start to fall, you'll know that the bite has started to really hit. And that is, again, leading indicator into recessionary mindsets.
Potentially, yeah.
We had conversations back in 22 around these interest rates might, if they go too hard, too fast, they might drive the market into recession. They didn't. Give them credit for that. But they've now gone really hard on rises on a inflationary pressure that's temporary. if they have to come down and come down quickly, that they've got to get their timing right so that we don't end up in recession. Now, if we get 1 quarter of negative growth, I'd like to see an immediate response, or I expect an immediate response from the RBA to go, no, too hard, go back, and then drop them pretty quick.
The increases, yeah.
That's correct.
And saying that you see a spike in unemployment, I think, as well. So that's going to be key to watch.
Yeah. All right, guys. For those who are in the results mentoring program, the get together is coming up next weekend. Very exciting times. We are most enthusiastic about that. And an incredibly comprehensive market update. More detail than we're able to put here today. For those who have just joined us,
make sure you fill out your profile, set up your notifications so you get reminded about events like this, RSVP to the upcoming events in the event space, and do answer that icebreaker question because that helps make you visible in the community and start to build those valuable relationships. But great to have you on board.
Guys, we want to thank you ever so much for joining us. Hope that has been informative for you. We do our best to cut the noise out for the purpose of getting to the heart of the matter. We also do take the opportunity to stand on our soapbox from time to time. And thank you very much for listening. Guys, be great. We'll talk soon. See ya.
See ya.